It's Brian Preston, the money guy.
Here's the thing I want to talk about, because people, we've already hit on this a little bit, Bo, but handicap by debt.
Yeah.
I mean, we even did a podcast talking about the Walking Dead.
The Walking Dead.
Play up on the zombies that you are when you have this heavy weight. And Warren is just saying he is obviously very adverse to debt, and when it comes to investing. And there's a way. A lot of people, if you're new to investing, you don't realize that there are ways that you can essentially amp up your performance by leverage.
That's right.
That's the fancy word for debt, is leverage, where you can go borrow to grow how big your returns are. You think about it, we already naturally do this with our personal residences. Mm-hmm. When you buy a house, you put down 20%. The other 80% is coming from the mortgage. That is leverage. That is a leveraged asset when you do that. So here's Warren's advice about debt when it comes to investing. It says, avoid the siren song of leveraged debt. And here's what he did. He's got from 1973 to, he goes through some periods. These are the biggest drops. So from 1973 to 75, there was a 59% drop in the markets. From 87, this is 1 month, from October 2nd of 87 to October 27th, the market lost 37%.
Oof.
Yeah, that was the Black Monday. Oof. So that was horrible. And then from June of 98 to March of 2000, market lost 48.9%. Okay. From September of 2008 to March 5th of 2009, the market lost 50.7. Huge drops. And this is his quote. He says, "This table offers the strongest argument I can muster against ever using borrowed money to own stocks. There is simply no telling how far stocks can fall in a short period. Even if your borrowings are small and your positions aren't immediately threatened by the plunging market, your mind may well become rattled by scary headlines and breathless commentary." He's saying be fearful of yourself, too. And an unsettled mind will not make good decisions. I mean, if you take that quote with the previous quote about in the short term, it's a voting machine versus in the long term, it's a weighing machine. And you read that and you go, wait a minute, those are in conflict with each other. You're like, why would I be an investor if I know I could lose 50% of my money over a 3-year period? What Warren is saying is, I think, and we'll get into it in a minute about risk, is that you have to understand, to be an investor, don't lock your money up in the market unless you can walk away from it for 5 to 7 years. If you're not walking away from your money as a long-term investor, if you think that you're saving for an engagement ring, you're saving for a house down payment, you're saving for something that you'll need within the next 3 years, you don't need to be in the financial markets.
That's right.
And I think that is the key component of what he's saying. Not to avoid investing, but not to go leverage yourself. Take unnecessary risk when you might need this money. So understand you've got to be long-term.
And then you also need to understand your personality. So how often, Brian, do we talk to someone who says, I have a huge risk tolerance. The market doesn't freak me out. I want to have 100% stock equity portfolio. And what generally happens is sometimes when the market freaks out and we see a day where it drops by 1,100 points, they're the first person to call.
Yep.
They may not really understand how well their risk tolerance is. And so one thing to understand is, even though you might be thinking you're making the best decisions because you understand risk and reward, and the more risk you take, the more reward you have, just like Warren says right here, that becomes completely derailed if you have an unsettled mind that doesn't allow you to make good decisions when it's really difficult to make those good decisions.
We all have really high thresholds for risk tolerance when the market's making money.
Exactly
I mean, because it's that greed. I mean, that fear and greed are just constantly in battle with each other. But I wanted to ask you, because Warren talked about this last year, and then he's followed up with the kind of the results this year, is that he made a bet. This is what's crazy to me. He made a bet in 2007 that the S&P 500 would outperform any of the hedge funds or anything else over the next 10 years. What happened in 2007? What was going on? What was that the precursor to?
Yeah, so in 2007, everything kind of felt like it was rocking and rolling. The markets had been on a tear, since the dot-com bubble. And so Warren came out and said, hey, guys, I think that let's pick the biggest and best and brightest minds out there, these professional managers who just are the wizards of Wall Street. And I'm willing to wager that if they build a bucket of their holdings versus me just putting a swath of my holdings in a low-cost, basically free S&P 500 fund, over the next 10 years, I think that my fund's going to do better.
And what I like about this, that echoes everything we just talked about with why you shouldn't try to time the markets. And even though, he talked about the value of cash, you also should just have a systematic savings, is that if we just put ourselves in Warren's mind in 2007, it probably looked pretty rich, just like it looks right now, is because 2007 is, if you could go look at it graphically, is right before we hit the cliff.
That's right.
So things are looking as good as they're going to get before you hit the next bear market. So that the timing is pretty spectacular if you think about what has happened over since 2007. He didn't mean to do that, but just it kind of, the lesson is learned there. So kind of tell us the rest of the story. What happened?
Yeah, so what he said is, okay, we're going to do this, and then 2008 happened, and then as it continued to build, Warren sort of broke out ahead, because what we found was that low-cost portfolio performed really, really well. And so I think this was in the shareholder letter this year. He said, if we look at the 43 10-year period since Warren and his team took control of Berkshire, years with gains by the S&P 500 have always exceeded loss years. And said more often than not, if you have a 10-year time period, the S&P is going to be up more than it's down. And
it said 100%, by the way.
Yeah, 100%
the actual
of the time.
quote is 100% of the 43 10-year periods, that rolling 10-year period,
right.
the gains exceeded the losses.
So if you want to bet on a horse, bet on the 100% horse is kind of what Warren was saying, if you have that long enough time frame.
And so I tell people, because I have a quote here that I wanted to read. A lot of you are probably thinking, okay, Warren is saying things might be overvalued. I need to start investing on a dollar cost averaging plan, but should I sit on the sideline because I'm nervous? Remember, 2007 was as good as it was going to get right before we fell off the cliff in 2008 with the Great Recession.
That's right.
But here's this quote from Warren. It says, "Let me emphasize that there was nothing aberrational or about the stock market behavior over the 10-year stretch. If a poll of investment experts had been asked late in 2007 for a forecast of long-term common stock returns, their guesses would have likely averaged close to the 8.5% actually delivered by the S&P 500. Making money in that environment should have been easy. Indeed, Wall Street helpers earned staggering sums while the group prospered. However, many of the investors experienced a lost decade."
Yeah.
And coming out of the downturn of 2008 and recovered it midway about March of 2009, there was all over the news reports, it was about the lost decade. And you just heard Warren talk about if you just stayed the course, that shouldn't happen. So it's very valuable to understand, don't try to time this thing. There's nothing wrong with having cash if you're meeting all those other goals, but make sure you have a plan that's taking advantage of it.
I think it's really interesting. In 2007, this was not the bet that Warren made. He did not make the bet, I'm going to wait until the market pulls back, and then I'm going to put my money to work, and then I'm going to outperform the active managers. He kind of bought high. I mean, it would have seemingly been high at the time, but because he knew that over the long term, the market tends to go up, and in the 10-year periods that he was examining, it went up 100% of the time. It wasn't a bad time to buy. And so we encourage everyone that same thing right now. Even though the markets have done really well, your 15 to 20% should be going to work for you even right now.
I thought it was interesting is that he went through all this. It was $1 million bet. That's all it was supposed to be. It was $1 million bet. And here's what I think was so smart about these two guys. You have the hedge fund guy and you have Warren, and the bet's going to be $1 million. So they each put up, it was $318,000, because that's what you'd have to buy into the treasury that was growing with the interest and so forth to get to $1 million over the next decade. Because each are going to have $500,000. So what is interesting is that because these guys are both sophisticated investors, some unique things happened in 2012 where this thing had captured a good portion of its principal well before 10 years.
Right.
So these guys took their $318,000 investments that had appreciated in the bonds and then put it into Berkshire, so that when this bet was actually paid out, they actually paid out $2,222,000. If that doesn't get you excited about the opportunity you have with your investments too, because realize you would have had similar results just by doing the S&P 500 as well with your portfolio. So just incredible to think about. Essentially, if you add both of those up, $636,000. That's what their combined investment to turn into $222,000. pretty incredible.
2.2 million.
2.2 million. Pretty incredible stuff to watch that money turn into that just over that decade
That's
period.
right.
Really powerful stuff. Shows you how valuable compounding interest is.
And again, that had nothing to do with Warren Buffett's stock picking ability. Had nothing to do with timing the market. Had nothing to do with, it was just going out and staying simple and smart.
And letting the money work for
Letting
you.
the money
army
work
of dollar bills getting out there and doing what it does. So I want to kind of close this thing out. I had a few things. I thought there was a combo tip that Warren kind of wound this whole thing down with. It was deferred gratification as well as understanding the nature of risk. Here's the quote. There's several of these. It was, investing is an activity in which consumption today is foregone in an attempt to allow greater consumption at a later date.
Deferred gratification.
That is deferred gratification. Risk is the possibility that this objective won't be obtained. So that's the thing. We always understand when we go out there and we take a little bit from today that we're hoping it will grow for tomorrow. And remember, we have done, and there's studies where where we've talked about this in other podcasts, for that 20-year-old that goes out there and saves $95 a month and just puts it in like an S&P 500, they're going to be shocked to find out that just doing that $95 a month, by the time they're 65, it's worth $1 million. Right. And then they find out that I only put in like $51,000. Yeah. So where did the other close to $950,000 come from? Came from the growth.
Sure.
I mean, that's what is so powerful when you just look at the mathematics of understanding you're just taking a portion of today to get something really miraculous in the future through that compounding growth. But you have to understand, the only way that happens also is you have to take a little bit of risk. You have to say, I'm going to take a chance that this might in the short term not work out very well, so that down in the long term, I have better opportunities.
And I thought that he did a fantastic job even framing up that risk. And again, this is a direct quote from the lady. It says, I want to quickly acknowledge that in any upcoming day, week, or even year, stocks will be riskier, far riskier than short-term U.S. bonds.
That's right.
But as an investor's investment horizon lengthens, a diversified portfolio of U.S. equities becomes progressively less risky than bonds, assuming that the stocks are purchased at a sensible multiple of earnings relative to the then prevailing interest rates. What he's saying is that as your time horizon lengthens, stocks are actually less risky than bonds. And that's because of the purchasing power. That's because of what happens to the value of your money over the long term.
And that's what I kind of want to close it out with, because I don't want anybody to read that and go, well, I turn 70 next week. I heard Warren say I ought to just go buy the S&P 500. I think that this is where, when you get to that level of success, it's where the art overcomes the science of what good portfolio management comes in. Because remember, just earlier, and even in this podcast, going over quotes from the 2017 letter to shareholders, Warren had talked about not how him and Charlie don't take more risk than necessary, because you don't want to go leverage or take on more risk than you need to and jeopardize something you've already obtained, which is financial independence. So I think there is a balance you need to understand, is that while you're retired, especially when you're retired, you're going to have to live off some of these assets. So you want to make sure that you have some liquidity, that you have a portion of the assets where you can go pull off of, but then you're in battle. There's a conflict. You're walking a tightrope. And the fact that you also want your money to continue to grow. Yeah. So how do you know what's the perfect mix? What do you need to know that you should have liquid so you can live off of for the coming years? Because what if we have another 2008?
That's right.
It might take 3 to 4 years to get back to where you need to be. You need to have 3 to 4 years of assets we can pull off of. How's that going to happen?
That's right.
And that's what I tell you, and it's all individualized. We try to give you so much free advice on this show. That's the abundance cycle we've done. And we've turned a lot of you into clients because you've recognized, hey, these guys think about money a little bit differently than I've ever heard. And plus, they're so willing to share that you probably, when you get to the point of assets that you're having these type of concerns, it makes sense that somebody gives you that individualized attention, because it's special for every one of you. What's your risk profile? Mm-hmm. What's your risk capacity? Meaning, how long can you wait because you need that money working for you that you can't even take the risk even if you have the tolerance? How old are you?
What are your goals?
What are your goals? How much do you already have working? How much do we need to help you grow into? All this stuff is very customized. And so we'd love to. We work with clients in the majority of the country.
Yep.
if you like what you hear, you like that we're nerdy enough that we actually get excited about Warren Buffett publishing his letter to shareholders every year, come check us out. You can go to moneyguy.com. You can reach out. We have a contact page. You can go if you want to see the firm we work with. It's Abound Wealth at aboundwealth.com.
Yep.
We also love everybody. Just give us your email address so you can get tied in. We have a free giveaway that we're going to be doing soon. We just put the final touches on it. You guys are going to love it. I mean, this thing is, if you're a person, because we don't try to work with everybody. We think a lot of you guys, before you get to $200,000, you can do a lot of this yourself. So we're going to try to even amp that up. We have some giveaways we're going to do for all of those listeners who are trying to figure out what they should be doing next, and they haven't hired an advisor. We're going to hopefully have some tools to help you kind of do your research and know what you should be doing. So give us your email address on moneyguy.com. You got to go check out the YouTube so you can see. I said it in the last show. You can see. Man, it's hard trying to pick out what to wear.
Oh, I'm sorry. Is that the YouTube they need to go check? Just go check it.
I'm old enough I can get away with saying I can say the Twitter, I can say YouTube.
The YouTube.
The
YouTube.
I made it French. The Twitter. I can say it all. You get to a certain age, people just smile at you. When I mispronounce words, they go, "Oh, bless his heart." I mean, that's the thing that we can get away with here. But it really is, and I think you can also sense we're nerdy enough that we love this stuff. We go get all the best credentials, but we don't talk to you like we're above you on this stuff. And I think that's what a lot of you guys, no matter how big and successful you are, you want somebody that can be your partner in this. They can have those fireside chats about what are we really trying to do with our finances. So thank you for tuning in. We love the growth. We love the emails. We love the comments that you guys are giving us. Just stay in contact, and we'll be back shortly. I'm your host, Brian Preston, with Mr. Bo Hansen. This is the Money Guy Show.